Hello, this is Richard Posson of the Posson Report, which is presented by Ag Financial Strategies at ag-financial.com. And today we're discussing supercycles. And first of all, I want to say that we're using a type of cycle called a time cycle, which has been well used over many decades by scientists, economists, market analysts, I think even historians and philosophers. And a time cycle is really, one example might be you have observed a stock that stops going down every 200 days. And so you find a bottom at that 200 day or somewhere around there, and you see prices run up 20 days, 100 days, 180 days, but at least 200 days later you're going to find prices are down. But about 200 days later you're also finding prices stop going down, and that does it again and again. So it becomes a repetitive bottom. So to show you a graphic example, this is actually wheat. It goes all the way back to, I think, the year 1260. It's probably a 10-year average for prices. And then they put this on a chart year to year with that 10-year average, I believe. At any rate, we have a bottom, and you can see it trended up, and then basically it trended down into a bottom around the early 1500s. And if you measure this amount of time, or distance on this chart, a horizontal distance from bottom to bottom, and then you extend that out, you're going to find that it actually rallied again and pulled back again into about the same time as the previous cycle. And on this one, we can see the more the better graphical portrayal of a cycle as far as bottom to bottom. You'll see at bottom, it trends up, tops, trends down into the next bottom, and then it's going to trend up again and down the next bottom. Now notice the distance from this low in the late 1600s to this low in the late 1800s is similar to the previous cycle coming back in the early 1500s, and also similar to the 1280s. So we have three cycles that I call a 216-year cycle. That's the label I give it. I'm not sure what it would average, but I've learned the cycle actually takes 180 to 230 years to bottom. Quite often, however, it's right around the 200-year mark. So you can do all kinds of statistical studies to show how this performs, to give you ideas of why it might perform, although you'll now have to dig into history and economics if you're looking at prices. But at any rate, we have this cycle. This is a super cycle of 216 years. Now, in my cyclical model, anything over a 10-year cycle, or actually I should say anything of 15 years or higher, or longer, larger, would be classified as a supercycle. And in our model, we have three types of supercycles, and then we have two long-term types of cycles that normally take a decade or less. Okay, so we have this 216-year cycle, and we have found it in wheat. Now, we've looked at cycle bottoms. What about cycle tops? Well, we've also learned that there's a similar pattern of 216-year cycle tops. And we've learned that if we split these cycles apart, you have just an uptrend, downtrend, no more, no less, and that for this cycle, that trend can last about 70 to 140 years. So it can actually double. It's very variable, volatile, sloppy, difficult to work with. But I have oversimplified that and called it the true 100-year bull market and true 100-year bear market. You may hear about other analysts. They're always talking about the stock market's got to crash. They've been talking about it since the 1980s to now, how the end of the world has to come because of a 100-year bear market. Well, I've come to the conclusion they're right, there is such a thing, but they're wrong in the characteristics of it. They don't know how it works, and they also don't know the timing of it. We're not in a 100-year bear market. But about 20 years from now, maybe 30 years top, we're probably going to start a 100-year bear market. But I've also learned the bear markets are not working as well as they used to. We will not allow prices to go down for 100 years because we cannot allow our paychecks to go down for 100 years. We cannot allow our economy to decline for 100 years. So we're going to fix things and do things. So those bear markets are not going to work. They're already not working as well as they should. But at any rate, this is the largest cycle we use in commodities. Now, when we switch to, and for the economy, and for stock market, but when we switch to things like climate, we have cycles all the way up to 100,000 years. And I'll make another video on that and discuss that in the future. But at any rate, I just want to show you this 216-year cycle we found for wheat. I've been talking about this for a decade now. It allowed me to say we would have a major bull market in commodities during the 2000s, although some of the smaller cycles were more important for that. So just something to consider. Okay, now that was wheat. We're now going to look at cattle. And this is a little bit different. It does show that we probably had a bottom in the late 1400s. Again, some markets early 1500s. We had another bottom in the late 1600s to early 1700s. And even though we can show the late 1800s as a bottom, really it looks to fit better with the 1932 crash in the stock market. So what we're coming up with a forecast is, I didn't explain the tops very well, but basically we have a top in the early 1800s. I'm going to show you that on the economy. And from the early 1800s to the 1930s, we were in a 100-year bear market. That was the downtrend of the 216-year cycle, and we'll show you it did not work very well at all. But from 1930s, we are now in a 100-year bull market. And as using smaller cycles inside of these larger cycles, these super cycles, we're coming up with a timing concept, which we call cycle series analysis. It's kind of similar to Schumpeter's model in his business cycle book. The suggestion we're in a 100-year bull market that will last just about 100 years. It's going to go from the 1930s to 2030s. I think 2042 is the latest I've calculated for a top. But anyways, here's another example of cattle. But what I want to point out is from sometime from the late 1400s, early 1500s, we wound up with a much more robust trend. Well, I've come to the conclusion there's cycles as large as 1,000 years that probably bottomed in the late 1400s, early 1500s. And it's almost like we had a miniature dark age there in the 1200s to 1400s. And we just decided, hey, we're better off inflating things, printing more money, having a better economy, making it easier for people to get involved in a good economy. So let's move on to the next report. This is a commodity index. So this is a commodity index that was put together by a couple of people in the Foundation for Studies of Commodities. And we have the same cyclical pattern, 1200 to 1400s, and then we see it on up into early 1700s, and then we see it coming in the 1930s, and then up again. Now this is a stock index put out by the same foundation. And basically we have a bottom in the late 1600s for the stock market, and then we have a bottom in the 1930s. So you can see the bear market didn't really work for this cycle. It's just too large. We can find smaller cycles that work very nicely along this trend. But look at this. In the late 1700s to about 1835, in my opinion, this is a log chart, but doesn't it look like it's a better trend than what occurred from the 1800s until you get to almost 1929 when price of the stock market just exploded. But also notice it then said, oops, I need to put that 216-year bottom in. I probably should have been going down for decades, and it just crashed. And it doesn't look like much on this log chart, but the stock market was actually down 90% when you don't look at it from a log perspective. And we had 30% unemployment, and the U.S. was on the verge of ceasing to exist, as well as many other countries. So it is very dynamic. It is very important. At any rate, if we look at tops from 1835, it looks like the stock market is rallying into about the 2030s, and then we're going to start a bear market. Now I've switched to a line chart of corn prices. We've actually got cash prices from 1720, and then we splice that on a reverse rate of change basis to French wheat prices that go all the way back to something like 1495. And what we found is that from late 1490s, there was a 216-year bull market, and then it came into a bear market, bottoming around 1707. And what we can do is break that 216-year cycle down into three 72-year cycles, which we did not label on this chart, but we can count three. And they break down into two 36-year cycles, or another way of looking at it would be six 36-year cycles going into a 216-year cycle bottom. We have 1, 2, 3, 4, 5, 6. No more, no less. Now the interesting thing is, for grains and many commodities, in fact, just about everything but the stock market, the cycle tops are different. The stock market likes to keep the same cycle tops as bottoms, but for just about everything else we've studied, we noticed that the nature of things is to have tops different than bottoms. And what we found is that instead of a 72-year cycle, there's actually a 54-year cycle inside of the 216-year cycle, and that would break down to a 27-year cycle. Now, some of you may recall the 54-year cycle is the famous Kondratiev cycle, and then that also gets into the Mayan calendar cycle. Okay, but what we learned is it didn't always work well. That at some point we found that there was a little blip here when there was actually another 27-year cycle inside, and so the 54 can be a little erratic and go a little longer. So we're more interested in the 27 these days once we learned that. At any rate, the 216-year cycle is due to peak for something like corn in the 2030s, along with the stock market, the economy, and many other things. So I've now switched to a different chart using cash corn prices only. So this is only from 1720 to now. In fact, this particular charting program, we cannot go beyond before 1800. So this actually starts with 1800. Now what we wanted to show is some of the interesting things we learned from these cycles. We have a few statistics here, but for the most part, right around 1817, there was a 216-year top for corn. And as I'll show you from other statistics say for the economy, that probably the economy peaked around 1812 with the 1812 war. Inflation peaked just about that time. The dollar probably peaked then. And it's like one by one from 1812 to 1817 we see everything peaked. The stock market appeared to have peaked, but later on the stock market kind of changed its mind and ran up to 1835. It was the oddball, about the only thing that did it. You might find a few individual commodities. Maybe gold was up in the 1820s, maybe cattle might have made another blip up, but most everything was peaking in the 1810s. And by the time the stock market peaked in the 1830s, then it was just downhill for the stock market all the way into the Civil War. So as we look at this, we can break this down into these 27, 54-year cycles that are all working very nicely. And basically we called for a major bull market into a 27-year cycle top for 2008 for many commodities, including corn. We're now seeing a correction of this, but eventually corn and all the other commodities are going to rally into the 2030s. The same is going to occur for our economy. It's going to grow into the 2030s. The stock market's going to rally, but the interesting thing is we're going to have higher interest rates, higher inflation. It's going to be something similar to the 1950s to 1970s when just about everything went up and the textbook said you can't have a positive correlation. You cannot have everything going up, but it did anyways. And that's about what we're setting up for is an inflationary time now for the 2030s. So now I'm going to bring in another chart. And this is the GDP, nominal GDP chart. And basically we had a 216-year top for the economy, started the 100-year bear market, dropped the economy by 48%. But in the late 1800s, it went higher, warning us the cycle was not working correctly. So switch down to lesser and lesser cycles, and then you'll be correct. You'll keep up with what's going on. And eventually the economy grew until it had to pull back in the 1930s when it dropped 49%, I believe. So it dropped just a little bit more than the drop in the early 1800s. That was so it's like the Great Bear started out in the early 1800s, then gave up, took an intermission for a very long period of time, and then came back in the 1930s to slam us. Since then, the nominal GDP per capita has grown at record pace, explosive pace, much better in the 1800s, and the reason was it was a 100-year bear market, not driving the economy down, but just slowing, trying to hold back the economy until that 216-year bottom was in place after the Depression, and then the economy just soared. The economy's been slowing down recently. I'm a little suspicious. We're starting to change how we view life. We want to get off some of this conservatism, corporatism. We're trying to change capitalism. Whatever's occurred in the last 30 years, we're over and done with it. And I'm thoroughly convinced there's some kind of pattern of inflation and disinflation, and that's all there is to life. We're over the disinflation. It's time for inflation, time for higher markets, and this all fits into a super cycle of 216 years, 72, and 36 years. It's all trending higher into the 2030s. I hope this has piqued your interest to investigate more of what we have of cycles, as well as do your own cyclical research. And in the future, I hope to do a super cycle about climate, where we look at some of the same cycles, but also can take it all the way up to a 100,000-year cycle that will show evidence of global warming. Thank you.